But let me bring in Fitzgerald Group Chief Investment Officer Keith Fitzgerald. Keith, just your thoughts in general on this market. It won't quit. I know all of the things, all of the logical things, all the things they teach you on Wall Street. 101, 202, 303 says we should be crashing, but the market won't quit.
Exactly. That's the best part about this is people have been arguing with you and me for years that stocks are expensive, that tech's going to go away, that the bears are going to come out. They've predicted 10 out of the last 2 recessions, Charles. A market like this exists because there's real profits and real companies making them. I think it's an extremely compelling and exciting time to be very focused on the trends of our lifetime.
So talk to us about that, because, I mean, we know generative AI, which I think has stolen some of the headlines from a lot of the other exciting things out there. This is the 4th industrial revolution, and that's just one component of it.
I don't watch Fox Business much, but when I do, it's very entertaining. Let's just put it that way. The way these folks talk is just so much different, man.
Well, it is, and people, Charles, they underestimate the magnitude of this. This is on par with the introduction of penicillin, the invention of electricity, distributed generation. I think, dare I say it, that AI may in fact be the single largest investment trend in recorded human history. I think it's going to add $30 to $50 a share to many companies, starting with Apple, Microsoft, NVIDIA, some of the great names that everybody's complaining about because they're so narrow and so expensive. They haven't even gotten started yet.
No. All right. Hold your horses for just a moment, please. Can we just hold our dang horses, sir? Holy smokus, how many 5-hour energies did you have, sir? Okay, can we just hold our horses before we start calling this the biggest investing opportunity in modern history or whatever we want to call this? Okay, you know, folks like this, I think, are the type of people that give maybe this AI investing cycle maybe a bad name. And I understand he has conviction around this and he's excited, and that's great. But it's just the way he comes across sounds kind of like more pumping type activity. There seems like there's no even keelness. It's just like, oh, this is so big. This is crazy, man. And you're totally missing out if you're not on this wave. So, man, we got to let these things play out a little bit, okay? Let's just let them play out.
Now, do we broaden that out, though? I mean, I guess there has to be a point, right, as a tool where it also helps you get to your bottom line, like a Tesla. I know you like Tesla, which, by the way, is another name Wall Street hates, but could you imagine if they really can get AI involved in there even to a greater degree?
Exactly, because that's the thing, right? Everybody who is poo-hooing it, particularly the perma bears who have had the stage for so many months now, what they don't understand is that they are inherently biased through the lens that they're looking at the rear view mirror. If you start to look forward...
Sir, the perma bears haven't had the stage this entire year, pretty much, okay? They had from Q4 2021 all the way through the beginning of Q4 2022. They had the stage for a year, okay? They had the stage for a year. They haven't had that stage this entire year for the whole 6 months.
Look forward, which is what Elon Musk, what Tim Cook does, what any of the prominent CEOs do. You see a very different picture. I would submit that the E hasn't even gotten started, particularly with that. And all the gamesmanship, forget about it. Your opening was brilliant today. You've got to be in to win, but you got to be in with the right companies.
All right, before I let you go, you've also been a little cautious in terms of, I think you told your subscribers it's not time to really spread your wings. What does that mean?
What that means is you want to play with the very best names, and I'm talking household names, top 1 or 2 positions in their respective industries. It's tempting to go out for the little guys, tempting to go out for the small stocks, but you're going to get skinned because you can't beat a supercomputer at chess. Why would you be able to beat a supercomputer highly leveraged trader that's going to pick you off like a grape off a vine? You got to stick with the big names because those things are going to power forward and endure the ups and downs.
And nobody wants to be a grape off the vine, I can tell you. Keith, thank you so much.
So, you know what was really concerning about that? Did you guys pick up on what I just picked up on here? Okay, this is extremely concerning. Extremely concerning. Listen to this again.
In their respective industries. It's tempting to go out for the little guys, tempting to go out for the small stocks, but you're going to get skinned because you can't beat a supercomputer at chess. Why would you be able to beat a supercomputer highly leveraged trader that's going to pick you off like a grape off a vine? You got to stick with the big names because those things are going to power forward and endure the ups and downs.
And nobody.
So this is where I hope you caught that, okay? This is where things get very confusing. Because this gentleman's talking about this is, biggest investing theme of our lifetime, blah, 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 whatever. Cool, okay. But then all of a sudden you're worried about traders picking you off? Like, what are we playing this for? Are we playing this for investment decisions, as in we're going to be in these for the next many years? Or is this like some little trading game that's like, this is where the hot moves are right now, so this is what we got to play? You know, that's the type of inconsistency I hate in the market. It's like, what are you? You know, then this happens a lot in the market where traders try to disguise themselves as investors. You're not the same. We are not the same. We are not the same. If you're a trader, you are not like me at all. We don't think the same. We don't do the same stuff. You're not listening to conference calls at 3 a.m. You're not reading annual reports. You're not doing any of this stuff, okay? You're looking at your little lines and your little charts and doing all your little stuff, okay? And I'm actually doing real stuff. And the real players that actually make the real money are the investors. We aren't the same. And so don't try to disguise like you're me, and then you're over here and you're talking about, you know, oh, we're trading in and out of this, and, you know, I got to worry about the... Like, at the end of the day, that's all irrelevant to an investor. I don't care what the machines are doing and the supercomputers are doing. It's completely irrelevant to me. It literally doesn't matter at all for an investment decision that's going to play out over the next several years. So that's just important to keep in mind. And I think a lot of you experienced folks in the market, you understand the difference between an investor and a trader. But for new people, they can get very confused. It's hard to draw the lines in between what is a stock trader and what is a stock investor. Investors are thinking long-term, years. Traders are thinking about tomorrow, today, next week, okay? There's a whole different ballgame there. Jerome Powell out with some very interesting comments here today, folks, about what the Fed's up to, what their next move is, and so I thought I would go ahead and react to this one in this video here today.
Our very own Sarah Eisen just finishing speaking with Fed Chair Powell, among other central bankers. Sarah, on a panel today where the headlines were coming. I don't see us getting back to 2% this year or next. That's one that jumped out to me, but there were many.
Thanks, Scott. Yeah, good morning. You know, look, good afternoon, I should say, from Sintra and to New York. If you were wondering where the Fed is going next after they took a break from hiking after 10 straight hikes 2 weeks ago in June, they decided to take a break, didn't call it a pause, didn't call it a skip. And after 500 basis points of tightening, Chair Powell today made it pretty clear, and I think went a little farther than he did last week in congressional testimony and the week before in his news conference, in suggesting there's more work to do on the inflation fight and tightening policy. Listen.
If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So the question is, how are they thinking of future rate hikes? The market is pricing in more coming in July. I asked him about the path from here.
The reason I want to listen to that again, let's hear if he gives us any tells here.
At the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough.
That's a tell. That's a tell right there, folks. Did you catch that? Did you catch that right there? He almost slipped up and said it's not restrictive enough, but then he changed his wording on that. Listen.
Policy is restrictive. It may not be restrictive enough.
He was about to say it's not restrictive enough. Instead, he realizes what he was going to make there a mistake, right? Basically something he didn't really want to say. He said it may not be restrictive enough, but he was about to say it's not restrictive enough. So that's an interesting tell there, folks. And that's sometimes why, you know, you can hear what somebody says, but you just want to listen to it again and say, is he, you know, saying something he wants to say or really not, right?
So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So the question is, how are they thinking of future rate hikes? The market is pricing in more coming in July. I asked him about the path from here. Maybe in every other meeting hike.
We've not decided that. So no, the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way. But I wouldn't take, moving at consecutive meetings off the table.
So really what you heard there, Scott, is that he did not, and he volunteered this information, rule out consecutive hikes in July and in September, which is where the market is starting to go. Also didn't really rule out the every other hike, but did make it clear that despite the fact that they paused, they're far from done. He also said, and you mentioned this on the inflation target, he revealed his own forecast in that dot plot, which is he doesn't expect us to get back to 2% target next year, thinks it'll take till 2025. So if you're thinking the Fed's going to be cutting rates, I don't know. He seems to suggest that they're going to have to be restrictive in these high rates for a long time.
Yeah, they'll have to stay up there for a while. Sarah, thank you. Good stuff. We appreciate it very much.
Thank you.
Our Sarah Eisen in Portugal for us.
Okay, so a few factors that I think are important here, okay? So in terms of trueflation numbers, for the month of May, it pretty much had us consistently in the threes, right, when it came to trueflation. At the very, very, very end of the month, it had us in the twos, but pretty much the whole month we were in the threes. U.S. government numbers came in at 4%, okay, so which means trueflation numbers were off anywhere between, let's call it 0.5% to 1%, roughly, okay? Now, this month, for the month of June, trueflation has had us pretty much, it has had us at 2% or below, or excuse me, in the twos, right, the entire month, literally the entire month. So what it looks like is the next U.S. government numbers will probably come in at like a 3.1 to 3.3 number, right, because we know it's not going to come in low like trueflation numbers are, even though I trust trueflation numbers a lot more than I trust the government numbers, but the government's going to make moves based upon what trueflation's at. Or excuse me, the government's going to make moves based upon what their numbers are at, not what trueflation's at, right? Now, an important thing to understand about that is when the government numbers come in at 3-something next month, the Fed's going to be in a real pickle to try to raise rates when you got Fed funds rate right now over 5%, and you got a situation where the CPI is going to come in at probably a low 3 number. That's a tough position to kind of take there. Now, Jerome Powell is still talking tough. He's still talking very tough. It hasn't been restrictive nearly long enough. We're going to have to stay restrictive for longer. We're going to have to potentially raise rates more. All these things. He's talking a big game. He's talking tough. Why is he doing that? The reason he's doing that is he can't call victory yet. At the end of the day, the government numbers came in at 4%. 4% is not in the twos, okay? 4% is not 2%. He can't call victory yet. He also doesn't want the market to get too excited. He also doesn't want commodities to start running, okay? And so that's why ultimately at the end of the day, he's still talking tough, and he's going to continue to talk tough until we get comfortably in the twos, month after month after month.